guys, it's Stock Curry, and the bad news surrounding an upcoming recession just got worse. In today's video, I'm going to let you know what that is, but I'm also going to share with you what you can buy now that will help you become wealthy in the future. So let's get into it! Before I get into the news that came out yesterday, I want to start with some definitions on what a recession is for those of you guys who are new to investing. A recession is defined as 2 quarters in a row of negative GDP. Now, this isn't a true negative GDP in the sense of our gross domestic product is going down. It's negative GDP compared to inflation. So if our GDP growth is actually going up, but inflation is going up even higher, that could trigger a negative, what they call real GDP. So real GDP is GDP minus inflation. Now in Q1 of this year, we got negative real GDP, which means the rate of growth of GDP was lower than that of inflation. And we are on the borderline of having a second quarter of negative real GDP. Right now, the Fed is predicting that the real GDP will come in somewhere below 1%. Now, exactly how far below 1% remains to be seen. So long as it's above 0%, we're not quite in a recession yet. However, if it does come in below 0% in Q2, then we are officially in a recession. Now, for a long time on this channel, both myself and others have been talking about how this recession could be a paper recession. And a paper recession just means that we have a recession on paper, a technical recession, but nobody in the real economy actually feels it. That is, tons of people already have jobs, they're employed, the housing market is strong. Nobody really feels the effects of the recession. It's just a recession on paper. However, there are some signs and indicators and signals coming out pointing to that possibly not being the case. That if we do in fact enter a recession in Q2, that we may actually be entering a real recession. A real recession is one that real people actually feel, you and I. It comes in the forms of lowering ability to buy things. That could be because of higher prices. Most likely it's because of layoffs. A lot of people end up getting laid off during a recession. The unemployment rate goes up. The number of jobs available goes down. The economy overall really does get worse. And unfortunately, we are now starting to see some signs of that actually happening. So let me get into the news that we got yesterday, and then I'll explain it, and then I'll let you know what you can buy now that can help you become wealthy in the future and take advantage of an upcoming recession. So on Tuesday, Janet Yellen and the World Bank said that they expect elevated inflation to persist. Now, while they do expect the rate of inflation to slow down, they said the problem is they think there's an increasing risk of stagflation. Stagflation is when the economy overall slows down or goes flat, but inflation remains high. And it's a very, very bad situation because the economy is getting worse, and yet inflation is still high. And the only way that central banks, such as the Federal Reserve, can fight off high inflation is to make the economy even worse, which really makes for a terrible recession, meaning the chances of a so-called soft landing, that is to get inflation under control without causing a recession, the chances of that actually happening are going to zero very quickly. It looks like the Federal Reserve and other central banks around the world are going to have to trigger significant recessions in order to get inflation under control. Now, this is not just happening in the United States. This actually gets a lot worse when you look at what's happening to the world overall. While Treasury Secretary Janet Yellen warned that the U.S. is likely facing a prolonged period of elevated inflation, the World Bank sharply lowered their global growth forecasts and flagged a risk of recession in many countries. Now think about that word, many countries. If many countries enter into a recession, then we are in the exact same boat that we were in 2008 when there was a global recession going on, in 1987 when there was a global recession going on, and in the 1970s when there was a global recession going on. In all of those time periods, the stock market went through massive declines, going down by as much as 60 to 80% in every single situation. So the little 15 to 30% decline that we've seen so far in the stock market could be nothing more than the very beginnings of a much greater storm, with an eventual decline of a total of 60 to 80% from highs, if we do in fact enter this global recession that the World Bank is warning about. The World Bank also projected several years of high global inflation reminiscent of the stagflation of the 1970s. Ouch. All I have to say about that is we don't want to see that happen, and yet it looks like that's the path that we're on. It's a terrible situation, and what it means is if we do in fact get the stagflation that both the World Bank and Janet Yellen are warning about, we are going to have a much worse recession than we even saw in 2008. We are going to have a recession the likes of which we saw in the 1970s, which was a multi-year recession. And it was so bad, it wasn't just one recession. It was like 3 recessions over a 10-year period. It's bad. The stock market at that time period dropped 80% from highs. It's not something that we want to have happen. There is some good news. I do have some hope for you. I'm going to share it in a minute. But first, let me get to what some companies are currently talking about. Because ultimately, at the end of the day, recession, inflation, whatever, it doesn't really matter. When it comes to the stock market, the only thing people really, truly care about at the end of the day are company earnings. So let's go see how the earnings forecasts look for the companies that so many people are invested in. On Tuesday, Target lowered their forecast and said profits would be squeezed from an aggressive plan to lower prices in order to get rid of unwanted inventory. So what do we have here? We have a company lowering their earnings forecast, meaning earnings are going down. Now, what makes this especially bad is the fact that Target just reported earnings a few weeks ago. They literally just reported earnings a few weeks ago, and here they are coming out just a few weeks later lowering the guidance that they gave just a few weeks ago. What changed in the last 3 weeks that caused Target to actually lower their earnings forecast? And more importantly, is this just a problem with Target? Or is this part of a larger problem that we're seeing across companies, across the entire stock market? Well, 3 weeks ago, Snap plunged 30% after they lowered their earnings forecast just 2 weeks after giving their earnings report. That's right, Snap did the exact same thing Target did. Snap came out, gave an earnings forecast, 2 weeks later, lowered it. So, okay, that's 2 companies. Maybe it's just those 2. Has anybody else done this? Well, sure, Microsoft lowered their fourth quarter guidance. And NVIDIA lowered their guidance as well. So we're seeing these lower earnings guidance come out not just amongst 1 or 2 companies. This is happening across the board. And it's happening to both mega companies, these large mega cap companies, as well as the smaller companies. It's literally happening across the board. Everybody is lowering their earnings guidance. Now, there are a few outliers, Lululemon and a few others that have actually raised their earnings guidance. But generally speaking, across the board, companies are lowering their earnings guidance, meaning they see inflation, high prices, they're seeing lower foot traffic in their stores, they're seeing lower shopping online. This is what Amazon reported. They're seeing the people that even do come into the stores are buying less. So overall, companies are seeing lower demand from consumers, they're spending less, they're shopping less, And overall, that is going to cause earnings and profits to drop significantly, not just for retailers, but even for technology companies such as Snap and Microsoft and NVIDIA. It's happening across the board. So this is really, really bad news. And what it means is, not only could the recession turn into a real recession where we really feel the effects and buying power goes down tremendously and we get significant layoffs and the economy really turns bad. In addition to that, the stock market really does look like it should continue to go down as companies continue to lower their earnings guidance. Now, here's the problem. If we do in fact enter into a real recession, and it looks like we will, the companies that are lowering their earnings guidance so far, this is just a start. It's the very beginnings of a trend that could occur for the next 1 to 2 years. This is what we saw in 2008. Think about in 2008 when the stock market started to come down. And the first few months, we had just a few companies, a few trickles of companies lowering guidance. And then slowly over the next few months, more and more companies started to lower guidance, and it balloons. And by the end of 2008, everybody had lowered guidance. Tons of companies had filed for bankruptcy. Companies had gone out of business. It was really bad. So that's the bad news. What's the good news? What can you do to profit from all of this? Well, the good news is that all of this fear that is occurring in the markets right now, the fear of a looming recession, the fear of companies lowering guidance, all of this fear is causing stock prices to come down. Now, does that mean you should just go out and buy up any stock that's down 60, 90%? No. You have to be very selective because there's a problem that is brewing on the horizon. Liquidity is drying up. The ability to borrow money is drying up. And companies that rely upon borrowing money in order to survive are not going to be able to borrow money in the future. And if they're not able to borrow money, they're not going to be able to survive. We saw this in the year 2000 when 52% of dot-com stocks went completely out of business. They went to zero. We saw this during the Great Recession when many businesses went out of business and went to zero. And we are about to see it again. This is not the first time. It will not be the last time. So when you go out and buy depressed stocks, you have to be very careful about what it is you're actually buying. There is a term in the stock market called zombie company. A zombie company is a company that is unprofitable and they have to borrow money in order to survive. These are companies that are constantly raising cash, either through doing share offerings or issuing corporate bonds or selling off assets. They're doing something to raise cash. And these zombie companies can survive for extraordinarily long periods of times until they're no longer able to raise cash. We saw this with Sears and JCPenney, companies that lost money for a decade before they were finally delisted from the stock market. We are seeing it with so many companies now. And it's not just small companies. I'm not just talking about those growth story stocks that they've never turned a profit in their entire life. This is happening with some very large companies as well. Companies like Uber and AMC. Companies like Rivian. Just any company that is not profitable, that has to raise cash in order to survive, they're going to have a very difficult time surviving a recession. And not all, but many of the companies, perhaps half of them, are going to go out of business by the time the recession is over. So you don't just want to invest in any company whose stock price is beat up, because you have a very good chance of that stock going to zero. You have a chance of losing literally your entire investment. Sorry guys, I have to interrupt this video for breaking news. This was literally just published as I was recording this video. Credit Suisse issues a profit warning for the second quarter, citing the Ukraine war and rate hikes. There you go guys, now we have banks also lowering their guidance. This is literally happening as I'm recording the video. Like I said, it is a balloon of bad news. It is going to continue to get worse and worse and worse and worse. All right, back to how you profit from all of this. How do you profit during this huge recession? What you want to do is you want to find the companies that are profitable and that have strong balance sheets and that are extremely undervalued on the stock price. Now, you don't have to do a whole discounted cash flow model in order to figure this out. It's really simple. All you do is go to the income statement of the financials. And what you want to do is scroll to the very bottom and look at EPS or earnings per share. If that EPS is a positive number, the company is profitable. That's the first thing you want to look out for. If the EPS is a negative number, the company is unprofitable. You don't want to touch it. Stay away. There's a good chance they could be out of business by the time the recession is over. The second thing you want to do is, say you find the company, it's profitable. The second thing you want to look at is the balance sheet. It's going to be the second tab in the financials. And what you want to do, real simple, you want to look at the top line. It's going to be called cash and cash equivalents. Look at that number and then scroll down to about the middle of it. Look at the short-term debt and the long-term debt. If the cash and cash equivalents is higher than the total debt, then that company has a strong balance sheet and there's a good chance that they can weather a recession. If the debt exceeds the cash and cash equivalents and short-term investments, then there's a good chance that if we enter a recession and the company's earnings or profits go down and they have to start digging into their cash in order to survive, they may not be able to pay off their debts. And there's a good chance that either that company could either go out of business or at the very least that the business is going to be far worse than it is today by the time a recession is over. So the stock price could still drop another 80 to 90% from here, no matter how far it's come down already. So here's what you want to do. You want to find the stocks that are profitable and that have strong balance sheets, meaning the cash equivalents, and short-term investments are more than the debt. If you've got a strong balance sheet and a profitable company, you're good to go. You can safely invest in that company. Now, the problem is even companies that are safe to invest in, the stock price could still fall significantly during a recession. So you don't want to get into a situation where you're buying a good company, but you're buying it while the stock price is still too high. So understand, there is a big difference between a great company and a great stock. There are a lot of great companies that have terrible stocks because the stock price is just way too high. Tesla is one in my mind. Great company, stock price is still too high considering the fact that we're about to enter a recession. Now, another situation you might be in is you might have a great stock where it's beat down 90%, but it's a terrible company, meaning they're not profitable and they have no cash and they're going to have to keep raising funds and they might be out of business. So there's a big difference between the company and the stock. What you want to find are the great companies, the companies that are profitable and have plenty of cash on hand and are also a great stock, meaning the value of the stock is extremely low. I found companies that are profitable, that have got plenty of cash on hand, and their stocks are trading at a PE or price to earnings ratio of 2 or less. Those are the companies that you want to find. Those are the companies that you can safely buy and invest in right now, knowing that even if we enter a recession, they're just not going to go down much further because they've already gone down. There's just nowhere further for them to fall. The problem is if you're buying a company that's not profitable and they don't have cash in hand, they're going to have to keep raising funds. I don't care how far that stock has gone down already. It could still fall a lot further. And in many cases, possibly, even most cases, it will fall to zero. So don't just buy a stock because it's beat down. Make sure the company is profitable and they have a strong balance sheet. If you find a company that's profitable and has a strong balance sheet and their PE ratio is 20 or higher, wait. I can almost guarantee you that stock price, it will fall significantly more over the next few months. Because we're in a recession, we are not at peak fear, we have a lot more pain and hurt to go in the stock market, and there is absolutely no reason why these stocks will not fall down to below fair valuation. Most stocks in the stock market should get to the point where they're undervalued. The only stocks I'm buying right now are the ones that are already extremely undervalued. And those are the ones you should be buying too, because if you buy into those stocks right now, once this recession is finally over, and it may take a year or two, but once this recession is finally over, those stocks that have a PE ratio of 2 are eventually going to get back up to a PE ratio of 15. And guess what? I'm going to have a 750% profit on those stocks. I guarantee you it's going to happen because I have seen it happen over and over and over and over again. I saw it happen at the end of the dot-com crisis. I saw it happen at the end of 2009, and it's going to happen again because history repeats itself. So I guarantee you, if you go find those stocks that are extremely undervalued, that are profitable, that have plenty of cash in hand to weather a recession, that eventually, and it may take 4 or 5 or 6 years, but eventually you are going to make a massive profit on those stocks, and you will significantly beat the overall stock market returns. There are so many people in history who have done this. Warren Buffett, John Templeton, who have used this strategy to become billionaires in the stock market. And you can do it too. Now, you may not have enough time left on this world to become a billionaire, but there's no reason you can't become a millionaire. So let's go get it. Let's get those profits. Let's get that money. Let's go find those stocks that are extremely undervalued, and let's go make our millions over the next few years. Guys, I hope you enjoyed this video and got a lot out of it. Please, before you go, make sure you hit the like button and subscribe. If you're on YouTube, go ahead and click the bell icon and click all, and I will see you in the next video.